Today, we're talking about something that sits pretty close to my heart and a lot of our clients' hearts. Tasmania or Victoria for your property investment journey in 2026. Ladies and gentlemen, it's Sean here from PropSpotter, helping you make the smarter way home. This has been at the top of many debates in 2025. And the way I look at it, there's really only a few key things you need to be aware when you're making that decision about Melbourne and Geelong up against Hobart and Launceston. So let's break into it. Firstly, yield. When you're considering your property investment journey, there's been a different video where I've spoken about yield, so you can go back and watch that and why it's important. But in this particular example, Melbourne and Geelong have much lower yields than what you could get in Hobart and Launceston. And that impacts your cash flow, your ability to hold, and the amount of money you'd have to take out of your own back pocket to make property repayments. I'm not going to go into the full detail in this video, but what you do see is yield in Melbourne and Geelong tend to sit at anywhere between 2.5% to 3.5% currently. As we enter into 2026, expect that to get lower. And that means you'd have to take out more money out of your back pocket to essentially keep the property going and keep the repayments made on time. When you look at Hobart, the yields in Hobart are currently sitting anywhere from 3.5% all the way up in excess of 5%, depending on where you buy and what you buy. Now, with investor loans sitting at about 5.7%, you could go into 2026 with the 2 expected rate hikes, paying a mortgage of about 6.3%. If you were to have a yield of 5% on a property up against a rate of 6.3%, you're still negatively geared depending on your LVR, but you're not as much out of pocket as you may think. Compare that with you holding onto a Geelong property that has a yield of 3%. Now, you're really going to feel the pain there as you pay $2,000, $3,000, or even $4,000 a month out of your back pocket to keep the repayments made. Now, that is probably the first consideration I think is very important on your property investing journey. The second one is vacancy rate. Now, at a high level, vacancy rate is quite important because tenants keep cash flow coming in. And the last thing you'd want to do is buy into a suburb where there are no tenants or there is a very limited pool of tenants, because you will be competing with others, there will be excess stock in the market, and you could be sitting and waiting months for a tenant to take on your property. I thought it'd be privy to sort of cover some of the data from December around vacancy rates in Melbourne and compare those to the ones in Hobart, right? And these are investor-friendly suburbs, so I may miss a couple that you're considering there. But from what I found in Melbourne, and I'm going to rattle off a few suburbs here, it paints a very, very different picture. So the lowest investor-friendly vacancy rate that I could find in Melbourne was Carrum Downs, which was sitting at 1.52%. Not bad. Derrimut at 1.65%. West Meadows and St Albans at 1.95%. Moonee Ponds, 2.1%. Hoppers Crossing, 3.63%, Melton 3.93%, Tarneet 5.3%, Truganina 6.43%, Wyndham Vale 8.23%, Calcalo 8.9%, and finally Donnybrook at 11.25%. I think based on that list, you'd be able to ascertain that there are balanced markets in Melbourne and there are very, very unbalanced markets in Melbourne. So go into it with your eyes wide open and ensure you make the right decision for yourself. Hobart, however, paints a very, very different picture. And again, I'm going to rattle off a couple of suburbs here from lowest to highest, what I see in the market as at December 2025. Warrane, 0.32%. Glenorchy, 0.42%. Moona, 0.47%. Bridgewater, 0.47%. Gagebrook, 0.76%. Claremont, 0.8%. Berrydale, 0.95%. Howrah, 1.07%. Risdon Vale, 1.23%. Kingston, 1.5%. And Bellerive, 2.5%. That is a very, very different picture to what you see over in Melbourne, and it looks like demand is meeting supply. In most markets, there isn't enough supply to meet demand, and in some markets like Bellerive, they are at the top end of being balanced. There is a real housing shortage in Tasmania, particularly in Hobart. Most properties are getting rented out within a week, and savvy investors are doing all of this prior to settlement in order to better manage their cash flow. Because of this demand and supply imbalance, there is also an element of price elasticity, as there are many tenants on the market all at once looking for property. So you get people lobbing in bids of $20 to $40 more per week in order to secure the property. In addition, you also get a choice of tenants in order to mitigate your risk. However, in Melbourne and Geelong, as I mentioned previously, it can be a very, very different story. Certain suburbs like Craigieburn, Pakenham, and the ones I listed above have a vacancy rate of greater than 3%. This can mean it can take anywhere from 3 to 6 weeks or even more to find a tenant for your property, and you'd have to be creative and ready to drop your prices in order to get it tenanted. Most of you will now say, well, Sean, that's all good and well, but what about the fundamentals? Now, let's cover them off separately. Melbourne and Geelong in one bucket and Hobart and Launceston in another. Now, Melbourne and Geelong undoubtedly have deep and diversified labor markets, more industries, more employers, and less reliance on a single sector, which essentially means over time, consistent rental demand and less volatility. On top of that, household incomes are higher. You've got plenty of suburbs in Melbourne and Geelong where household incomes exceed $140,000. Think of Belmont and Grovedale in Geelong and countless others in Melbourne. The third item, infrastructure. The dollars going into Melbourne are unmatched and Geelong. You've got the Metro Tunnel, you've got the West Cape Tunnel, which just launched last month, which will completely change how people view that entire Melbourne Geelong corridor and Mornington Peninsula on the other side. When you put that beside Tasmania, where you've got demand but not as much infrastructure, you have a smaller, more concentrated economy, particularly outside of Hobart. Regional areas will rely on fewer industries and employers to keep them going. Income levels in Hobart and regional Tasmania are also lower. This creates a rent ceiling. Rents can grow when budgets are tight, but you'll either see multiple families moving into the one roof or ceilings start to be hit. Currently in Tasmania, it's hard to get rental past $700 or $750 a week. Your rental pool is really, really limited. On the infrastructure front, Bridgewater, a suburb I've talked about a few times now, is an interesting one. An upgraded bridge was just opened there 2 months ago, 3 lanes each way from the side of Hobart into Bridgewater and vice versa. That has cut down commute time significantly and will in the coming years bring in more people and gentrify the area. In short, that's already happening from my trip down there last month. To conclude, if you've got deep pockets, Victoria can reward you with the higher incomes. However, the supply is far from being constrained. It could be a long road ahead. So you need to be open with waiting longer for that capital growth in general. If your pockets are not as deep, Tasmania and Hobart in particular can be a city that rewards you practically immediately if you buy well, but you have to ensure that you select suburbs and assets that are scarce and will continue to be scarce to maximize your capital growth for the long-term future. If you need some help or want to have a absolutely no obligation chat on your property journey, feel free to book in some time with the PropSpotter team at propspotter.com.au.